Good evening, everyone. I hope all of you are doing good and keeping healthy. Welcome back to the second session of Cost of Capital. I am CA Manobhav Verma, also CPA from US. We'll be continuing to your offer for this topic and a couple of more important topics later during this batch, probably next month. So welcome you all once again. We had a fantabulous Tuesday evening with all of you, and I'm pretty sure that we are all looking forward for another equivalent, interesting and participative session. And I can see a lot of excitement already as I'm looking onto the chat box. So Ria asked about a good summary of the lecture where you could understand the important points. So Ria will be wrapping up the chapter today, and probably you will yourself get the jinx of it. So just to give you a recap of what we discussed on Tuesday, we talk about our individual cost components of cost of debt, where we talk about the irredeemable and the redeemable debt, various methods, YTM. We also talk about the amortization of bond, and then we also talk about cost of preference shares. More importantly, we also covered the cost of equity using 5 methods, and I specifically mentioned to you a couple of methods more important amongst those: the growth model, the Gordon's growth model, and the capital asset pricing model. So I'm sure that you all got a chance to cover up whatever was discussed till last lecture, right? So we talk about now, continue our discussion, whatever was left. And you know that we always start with a question actually. So my question here is, where do you actually reflect retained earnings in the financial statements? If your answer is balance sheet, then in balance sheet exactly where? So let's see who wants to answer this one. So my question is, where do we exactly carry retained earnings in the balance sheet? Which section? Okay, let's see who responds. Reserves and surplus. Everyone says Vivek, Pooja, everyone is saying like reserves and surplus. Good. So are we all on the same page that basically this is coming under equity section? Everyone says P&L, reserves and surplus. Vinda, Saurabh, yeah, absolutely. So basically we are all on the same page that it's part of the equity section. We are saying specifically as cost of retained earnings. Now, since cost of retained earnings is anyways able to, I would say anyways enabled to be a part of equity itself, don't you think the cost of equity should be the cost of retained earnings also, or vice versa? Like cost of retained earnings should also be the part. Some of the amount is distributed as a dividend, some of the amount is reinvested. So retained earnings cost should be the cost of the equity. Generally, yes. But the interesting factor is when we issue a new equity, we end up incurring some cost like a flotation cost. But generally, the cost of new equity is considered to be higher than the cost of existing equity or even cost of retained earnings, because you might incur some flotation cost, right? So, okay, I was just seeing a couple of more responses. So, Sneha, I was just going through your message. Sneha, it's up to you, I guess. You can continue to attend this one definitely, and you can watch the last one after this lecture. That's absolutely okay. Okay, couple of questions with respect to some illustrations on the study guide, guys. Let me focus on some of the questions I've already selected today. But in case you have any other doubts, we can touch base that on later on. Okay. Yeah. So I was talking about the cost of retained earnings, where it should be part of the equity itself, because that is anyways the part of equity. So cost of equity should be cost of retained earnings. But if there is a new equity raised, you might incur a flotation cost, and you basically end up having a higher cost of equity. Another important aspect, or rather different perspective of looking at retained earnings. What are these retained earnings? These are the earnings which is not distributed to the shareholders. So these are not distributed. If these are not distributed, that means we could say that yes, cost of retained earnings is the opportunity cost of the dividends foregone by the shareholders. So basically we're saying that, okay, it's kind of same as KE. And as I said, in case of new equity, the cost of equity would be higher. The reason is, of course, your denominator, your net proceeds would be kind of net of a flotation cost. So it will be more. Now, there could be a scenario that on a hypothetical basis, that there is no flotation cost. Then we'd say that, okay, KRS is equal to KE. Basically, it is same as where my retained earnings are basically the cost of retained earnings is same as the existing equity. Because in the new equity is hypothetical that you generally don't have a flotation cost. But what is important to look at is, if there are flotation costs and there are taxes, what does this mean is, let's say that since this is the opportunity cost of the dividend foregone, had these been actually distributed to the shareholders as a dividend, they would have paid their share of taxes. They would have invested somewhere else, probably another flotation cost. As a result of it, the cost of retained earnings would become net of the tax and the flotation cost. So if you have been posed with a question where they indicate you, okay, that there are some taxes and flotation costs with respect to the retained earnings, that means we are just assuming that, okay, if this was being distributed, there would have been a taxes paid, and also any investment with respect to the same or other reinvestment would have resulted in a flotation cost. That would definitely be encountered as a net cost of retained earnings. So the second formula is interesting here. That means what we are saying that, okay, if there are taxes, there are flotation costs, then cost of retained earnings is cost of equity, net of taxes, net of flotation cost. So otherwise, as a general rule, if you ask me, as a general rule, we will say that, okay, cost of retained earnings is equal to cost of equity here. So let's talk about an illustration here. So face value of the equity shares of a company is 10, while the current price is rupees 200. The company is going to start a new project and is planning to finance it partially by a new issue and partially by retained earnings. You are required to compute the cost of equity shares as well as cost of retained earnings. If the issue price will be 190 and the flotation cost will be 5 per share. Now, dividend at the end of the year, first year, is expected to be rupees 10 and growth rate will be 5%. Now, what are we expected to kind of find here? We are saying that, okay, cost of equity shares as well as cost of retained earnings. Guys, which model do we apply on here for the cost of equity? Which model do we apply here? Any thoughts? Which model should we apply on? Should we apply a earnings price approach, realized yield, Gordon's growth approach? Okay. So Khushi says that we will be applying a growth approach here. So that means you are looking at a D1 upon P0 plus G. That's what you are looking forward for. So what will be my, okay, so Pooja also said growth model. Yes, Saurabh, absolutely. So in this case, we need to calculate what is my D1. So let's solve it together. So we're talking interestingly in this case is given to us already end of the first year. Very important, guys. In this illustration, this is very important. Dividend at the end of the first year is expected to be rupees 10. That means they're already giving us D1. This is not D0. Don't multiply it by 1 plus 0.05 again. This is already D1. So we're talking about D1, that's 10. They're talking about 190, that is plus 0.05. That's what we are calculating here. But yes, 190, you also have a 5 flotation cost here. Where exactly? They have given us a flotation cost as well. So flotation cost will be a 5 per share. So this 190 will be further reduced. So this is again the same formula, D1 upon the NP, net proceeds, or in case of existing equity, it was P0 plus D. So in this case, it's a new equity. So 10 upon 185 plus a 5% in this case, which is giving us a cost of equity of 10.41%. 10.41. Okay. Any questions, guys, on the cost of equity front? I guess this is absolutely okay. Cost of equity should be absolutely fine. Now, what about the cost of retained earnings? Now, as I said, in the case of new equity, the cost of equity would be higher. In this case, that's what we are just proving here to be. My cost of retained earnings is based on my existing equity. So this was mainly for a new equity. Whereas in terms of cost of retained earnings, I'm calculating D1 upon market value plus Z, that is 10 upon 200, and that is giving us 10%. So this example is giving us that yes, my KE is more than KR. Reason being that this is a new equity here. And because you are talking about new equity, you are having a lower denominator. Your net proceeds is less. I hope this makes sense to everyone, guys. Great. So another thing is they're talking about another illustration. They're saying that cost of equity of a company is 20%. Rate of flotation cost is of 5%. And personal taxes is 30%. If this is a kind of a situation, they are giving you flotation cost and the tax rate. That means you are talking about a situation cost of retained earnings. If that retained earnings, think from an investor perspective, what is the opportunity cost? Had that been distributed to the investor, they would have paid taxes. If they would have invested somewhere, they would have incurred this flotation cost. So in that case, my cost of retained earnings will be cost of equity net of the flotation cost and personal taxes. And that is why the cost of retained earnings will be 13.3%, guys. I hope this is making sense to everyone. Can you please confirm if both the illustrations are clear to all of you, please? I hope there are no doubts. If in case there are doubts, please let me know. Just looking at the Q&A box in case anyone wanted to ask anything. If it's all clear, that's perfect. This second session of cost of capital, I hope we are all super energetic, and I'm sure Josh is still high as on the other day. Somehow I am not able to see any responses since last couple of minutes. Yes, can you please confirm any doubts, anything, or if it's all okay till now? Great. Just saw a response from Khushi. Great. Good, guys. So I think that's absolutely clear to everyone. Now, couple of questions for you guys. Question number A and question number B. So we have to calculate the cost of retained earnings in the following scenarios. Let's see. Who will be giving me the answer for question number A here? Question number A. So question number A is where D0 is given to us as 5, P0 is given as 50 and G is 5%. Pooja had a question on the last illustration. Pooja, because we considered the market price because cost of retained earning we are talking about in case of a it's kind of a same as a cost of equity. So in the existing equity we use the market price. So let me go back for you quickly. So generally we are talking about KR is equal to KE. That's it. Nothing else. I hope that is clear. Okay, Charu, I guess probably the screen visibility is is an issue at your end because no one else has commented on the screen visibility. Please check at your end as well. Everyone else is able to confirm. Okay, so I got one answer. Okay, thanks. Thanks for confirming. So guys, let's check at your end. Okay, so I'm getting the couple of answers here as 10.5%, 15.5%, and 13.3%. Let's see what is happening in question number A. We're talking about equal to cost of retained earnings equal to cost of equity here. That's pretty much sure. So let's try to calculate this. D1 upon P0 plus G. So D1 is 5 into 1.05. P0 is 50 plus 0.05. I think that should be question number A. That should be question number A. Any thoughts, guys? So that means we are looking at a 15.5. I think those of you said me 15.5 seems to be a good answer. What about question number B, guys? CAPM. So question number A seems to be a 15.5. What about question number B, which is a capital asset pricing model? Let's see what is the question number B. Vivek has an interesting question. Vivek says, why are we calculating cost of retained earnings? Opportunity cost losing by shareholders, any effect on losing opportunity cost by shareholder on company? Okay, Vivek, I will partially answer your question now and partially little later. When the company is expanding, you know, you need to understand couple of things. First of all, the retained earnings is part of the equity, share capital, reserves and surplus, any securities premium, it's all part of the equity. So generally we say that cost of retained earnings is equal to cost of equity itself. So that means if I'm using the equity portion for, let's say, a reserves and surplus portion to reinvest in the business for expansion and growth, then anyways I'm using the same cost. It's not an additional cost. Reserves and surplus, part of the equity section itself. But when we are talking about from an expansion perspective and also raising some money from outside, we will have to consider the aspect, how much am I reinvesting and how much I am raising in additional capital. That means my cost will be different. Cost of a new equity will be different than the cost of the retained earnings. I hope that makes sense, Vivek. Okay, a question coming in from Vrinda. 1.05 from where? Okay, interesting question. Vrinda, in growth model, we use D1. D1 is equal to D0 multiplied by 1 plus G. Vrinda, I hope that is clear now. Okay, for B, I am getting two answers, 11.2 and 13.67. 13.6 or 13.78. So I'm getting two answers here. So let's understand this one as well. Okay, so we are saying that cost of equity is RF plus beta into RM minus RF. So that's the model we discussed the other day around. So we're looking at a 6 plus the difference between the two. So we're talking about beta into that is 10 minus 6, so 0.04. So it seems that 11.2% is a good answer here. So I think most of you gave me 11.2. That seems to be a good answer. So those of you got an answer different than 11.2, please check. Vivek, I hope your doubt is clear. Vrinda, I hope you got the point. So very soon we will be starting a lot of practice today, guys, where you will have to be kind of with me. Great. So let's have some brain teasers, guys. Let's talk about a couple of few brain teasers here. What about question number 1 here? Now these will be quick answers from your side. Question number 1. Question number 1, guys. Let's see what is the response for question number 1. So given the risk-free rate of 6%, market rate of return is 12%, cost of equity is 18. They're asking us value of beta. That's interesting. So that means they've given us cost of equity for us. So cost of equity is given to us as 18%, guys. RF is 6. So that means the risk premium should be 12% and the differential is 6. So what will be the beta then? I think we are looking at this as a 18% is equal to 6 plus beta 12 minus 6. So that means beta is 12.6, that's 2. And that is absolutely the correct answer. I think good round of applause for those of you who said D here. What about question number 2, guys? What about question number 2? Okay, for 2, everyone is giving me an option number B here. Which of the following source of funds relate to reinvestment or implicit capital? I think the important word here is implicit capital. It's an implied capital, right? You're kind of reinvesting within the business. And I guess you guys are absolutely spot on when you are saying option number B here. Good job, guys. I think unanimous answer received for both the questions. So that's amazing. Great, guys. That was a good one. Let's talk about question number 3 then. Which of the following statement is false? Which of the following statements are false? So, okay, I'm getting C, A. Charu said C. Jyot also said C. Riya said A. Does retained earnings have a cost? I guess that's what we are discussing, isn't it? If I want to discuss everything, the problem is it's do not involve any cost. So these definitely involve the cost. So it's a false statement. Weighted average cost is a sum total of cost of capital from various sources. We will be discussing this. We are yet to discuss weighted average cost of capital, but this is never a sum total. We'll be doing a weighted average. So this is a false. Tax shield on the preference dividends reduces the cost of capital. Did I talk about the tax shield on the preference dividend, guys? Or I talk about tax shield on the interest on debentures? Interest on debt, I guess. So the tax shield is never there. It's not there on the dividend. So this is also false. So the correct answer is D here, guys. So I think question number 3, you guys need to be careful. I think most of you got it wrong. Vrinda said correct. Vrinda, you were spot on, but I think many students for question number 3 were wrong. Please double check. Great. So guys, be careful. These questions could be tricky. Okay, so what about question number 4? Some students have already given me answer for question number 4, but the answers are different. Some of you are saying A, some of you are saying C. I told you this as a last slide in my previous lecture that the government bonds are probably the most least risk or risk-free almost. So I anyways gave the answer in the last class itself. So it is the interest on government bonds is a risk-free rate of return. So this is all it is. So someone said, see guys, risk premium is nothing but a market rate, excess of market rate over the risk free rate. That's not the government bonds. So 4 is A. Majority of you got it right though. Okay, great guys. Now let's move on. Let's make a move here. Let's talk about weighted average cost of capital. Now, whatever we have discussed till now, it all actually boils down to this moment. For all the various individual components of cost of capital, we are discussing a weighted average cost of capital, overall cost of capital. And we know that the entire capital of the business comes from various sources, multiple sources of capital, which could be debt, which could be preference share, which could be equity shares. What we do is, the point is that the entire capital may not be equally coming from various sources. You may have a equity more than the debt or vice versa. And that is why we apply the weights to each component. On what basis? Based on the proportion to the total capital. So whatever is the total capital, I will take that. I will take those proportions as a weight, kind of a weight. So there we are talking about individual cost component is multiplied by those weights. So whatever the weight of debt will be multiplied by the cost of debt. Similarly, preference shares, equity and retained earnings. So these W will be the weight. So that is my WACC or the WACC. Now the most interestingly, the weights can be based on book value of individual components or could be based on the market value. Most important point where we need to understand is, of course, the question will tell us that yes, whether we are looking at a book value or a market value. Some of the questions ask you to calculate WACC both on the basis of book value or the market value. So they will give you the market value of the equity share, debenture or whatever. However, the interesting point will be whenever the market value is used, the market value of equity will actually be a total equity. That means including the equity and the retained earnings. In that case, that market value of the equity will have to be apportioned or split based on the book value of equity and retained earnings. Mind you, in my balance sheet, you have a share capital, you have a retained earning. But when I'm using a market value, like market value of this share of this company is, let's say, a 220. I will multiply that with the number of shares. That's a market value of the entire equity component. That will have to be split into the share capital and retained earnings based on the book values. So we'll allocate the market value to the retained earnings and the share capital. So that just be careful of that. We will come on that piece also little later while we'll be practicing. Okay. So and the reason is absolutely mentioned at the bottom, says there is no separate market here. So the market value of the equity includes both paid up capital and retained earnings. And also the important point is, I said that cost of retained earnings and cost of equity may be different because your new equity cost is generally more because of the flotation cost. So it's important that even if you are using the market value weights, you are getting to know the differentiation. You are calculating the weighted average based on the individual components. I hope this makes sense, guys. So let's do a sample illustration here. So cost of equity of a company is given to us at 10.41%. Well, the cost of retained earnings is 10%. Now, there are 50,000 equity shares of 10 each, retained earnings of 15 lakhs. Market price is given to us as 50. And they're saying that WACC using the market value weights. What I'm trying to say here is, we need to understand that if I'm applying the market value of 50, probably I know the market value is 50 into 50,000 guys. So that comes out to be 25 lakhs. Guys, is everyone with me on this? 25 lakhs is the market value of the equity, guys. How would I allocate this? In what proportion? Can anyone tell me? This is market value. The question is I have to calculate the WACC using market value weights. I have got the total market value of 25 lakhs. But as I said, to further split it into equity and retained earnings, you need a book value of them. So my equity is 5 lakhs and my retained earnings is given to me is a 20 lakhs. So that means total of 25 is anyways coming out to be coincidentally. So that means my ratio becomes 1:4. 1:4. So I allocate in the 1:4, or do I do something else? Can anyone tell me what ratio should we use? On what ratio we are doing here? How do we calculate this? Okay, someone says 1.3 because retained earning is given to us is up 15 lakhs. Okay, let us make it 15. So 15 plus 5 is 20. So it becomes 1:3. So Ria said it is 1:3. Okay, Ria, I did it 1:3. So what will be the proportion going to the equity share capital? So retained earnings is 15 lakhs, not 20 lakhs. Thanks for letting me know. So we are talking about a retained earnings of 15 lakhs here. So 5 lakhs is a equity and the retained earnings is a 15 lakhs. So that means my total book value of equity is 20 lakhs. My market value is 25. This 25 is allocated based on 1:3 guys. So that means 25 lakhs into 1/4, 25 lakhs into 3/4. So that's basically equity and retained earnings allocation. I hope this is making sense to everyone. And rest of the game is pretty easy. So once we know this weight, we have to just multiply to the respective component, 10.41 and 10% that is given to us. So my weighted average cost of capital based on the market value is straightforward. Pooja, that was 1.3. So I accidentally wrote retained earnings as 20. It was 15. So correct it to 15 lakhs. I hope everyone is okay here. Okay, great. Let's try to solve it quickly now. This one. So this illustration could help us. They've given us various aspects. WACC using the book value and market value as a weights. And they're giving us some capital structure. We have debentures, very good. We have preference shares. We have preference shares market price, equity shares with market price. There's given some additional information also. Debentures are redeemable, great. Preference shares redeemable, equity shares. Next year expected dividend is given to us. And they are saying that use the yield to maturity method to calculate the cost of debentures and preference shares. That means we are calculating NPV or rather at two different rates to calculate the IRR, I guess. So this is an interesting question. So to start with, let's work around this. Let's talk about cost of debentures first, probably. So redeemable debenture, but they have specifically told us that, hey guys, you need to use a YTM. You need to use a YTM method. They specifically told us, and they specifically told us don't apply the other formula. So YTM method is required, guys. So what was the crux of the YTM method, guys? How did we talk about two rates from the last class? Does anyone remember? We use a IRR formula, if you guys remember. So this involves a little bit of calculation. How did we select two rates? Ria, I will be talking about that. Ria, your question is calculating the discounting factor. Okay, so how do we calculate? I hope your question is not selecting. So selecting a rate could be random here. Okay, so let's talk about this. In IRR formula, guys, we use two random rates. We need one positive NPV and one negative NPV. So if my first NPV is positive at the first rate, then the second rate will be a higher rate. Similarly, if at the first rate the NPV is negative, then the second rate should be a lower rate. As simple. That's what I discussed on Tuesday. So let's focus on this. Now here what I have done is we're talking about a cost of debt using a YTM. Now they have given some information to us. 100 per debenture, that's my price, 10% coupon rate, 4% flotation cost, and 10-year maturity. That means for the 10 years, we are looking at a interest of 10. And are we talking about any tax rate? Yes, we are. So corporate tax is 10%. So that means my interest net will be 10 into 1 minus 0.3. So that means 7. Net interest cost would be a 7 here. And that's what we are doing. That's what we are considering here. 7. Also, since we are talking about debentures at 100 per debenture, what will be the initial amount we are discussing in this case? The capital structure with a market price of 105, right? We are looking at 105 in this case, and 4% flotation cost. So 105 minus 4.2, that is giving us a 100.8. 100.8 as an initial cash flow. That is 105 minus 4%, guys. And at the 10th year, there will be 100 of redemption value. I hope everyone is comfortable with the cash flows though. So what I took was first discounting rate as a random of 5%. So someone was asking me how to calculate the discounting factor. So let me just give you a good indication here. So let us say these are different years. These are years. From year 1 to 10, my cash flow is same, guys. Interest 7. So यहाँ पे we will be using a 1 upon 1.05, whatever the rate is. 1 upon 1.05 square. 1 upon 1.05 cube. And so on. For the 10th year, it will be 1 upon 1.05 to the power 10. Now, these are the rates which will be for each of the years over the 10 years. And if I add them up, this will be a 7.7217. So the discounting rates are basically based on the different number of periods we are talking about here. So when I did this for 5%, I got a positive NPV. So that means my next discounting rate had to be a larger one. 7% we tried. So when we tried 7%, I got a negative 0.80, and applying this formula, I'm getting an IRR of a 6.9%. That means my cost of debt is 6.9, guys. Guys, can you please confirm if this is now better? Last class we discussed one example for YTM, but this is again a repetition of another example, but this should take, kind of make things clear. Let me know if you guys have any doubt. So cost of debt is clear to everyone. 0.3, Vrinda is asking from where did you get 0.3? Vrinda, because my corporate tax rate is 30%. So my cost of debt, remember, it was interest into 1 minus T generally. My interest would reduce my tax liability by 30%, and hence my net interest relevant cash flow would be 7 only or not 10. Vrinda, I hope that makes sense. Now, cost of debt is done. We similarly talk about for preference, guys. Let's look at preference also. 100 per preference share, redeemable at par, 5% coupon rate, 2% flotation cost, and 10-year maturity. And what is the market value of the preference share? 110. And 2% is my flotation cost. And we are talking about 5% dividend. Guys, do we have a tax shield on preference dividend also? Yes or no? Do we have a tax shield on the preference dividend also? Yes or no, please? Can you guys confirm? Tax shield on preference dividend, yes or no? Okay, everyone is kind of unanimous. There is no tax shield. So that means 5 dividend of 5 remains 5. Okay, let's look at this. So this is 110 minus 2%, giving us a 107.8 in case of a new preference share. And I'm looking at a 5 as a dividend. Again, I took a 5% discounting factor as a first rate, and look at what I got. A negative net present value of minus 7.8, and hence from 5% I took a lower rate of 3% here, guys, to get a positive value. Guys, don't worry, you would be 99.99%, you'll be getting the annuity factors table, so don't worry about that. But you should know how to use the annuity factor table, right? So this is for 10 period. Look at the relevant annuity factor for 5% and 3%. So the same formula when I'm using, but remember when we are applying this formula, I told you one important aspect on the other day. My lower rate in this case is 3. NPV at a lower rate is 9.26. And when I do 9.26 minus, the other NPV is anyways in minus, multiplied by 5 minus 3. So this minus becomes plus. So it's important we understand this. So 9.26 plus 7.8. So we're looking at a 17.06 multiplied by 2. So we are getting a 4.09% then. So this is my cost of preference share, guys. So we have got a cost of debentures using YTM, cost of preference shares YTM. What are we left with? I think one more component was given to us. Equity shares, third point. Can anyone tell me which method we should apply for equity method, equity shares cost? Which method are we talking about? I think they are giving us a growth, aspect. Next year dividend is expected as a 1 rupee. Guys, should I multiply this? This is D0 or D1? So 1 is a next year expected dividend. So D1 already given to us, I guess. So that means we are looking at a D1 upon P0 plus G. So that means my P0, again, it's 24 minus the flotation cost. So flotation cost is 4. And the market price is 24. So my net proceeds, that means, is 1 upon 20 plus a G of 0.05. It means a 10% of cost of equity, guys. So cost of equity is done, 10%. Can everyone confirm here that you guys are with me on this one till cost of equity? Individual components is okay to everyone, please? Charu, Saurabh, Khushi, absolutely correct. And yes, of course, Pooja and Harsh, you too. So we all of us here got 3 respective components: cost of equity, cost of debt, and cost of preference shares. We all calculated this together. And now the point is the main question. We had to calculate the WACC using the book value and also market value as weights. So we're talking about both. First, let's talk about book value, guys. What is the book value weight? 5 lakh debentures, preference shares 5 lakhs, and 10 lakhs equity shares, guys. So 5, 5, 10. So that means if I'm looking at a book value, we're talking like 5 by 20, 5 by 20, and 10 by 20. 5, 5, and 10. So my cost of debt is 6.9. Preferential is 4.9 and equity is 10. I'm looking at a 7.75% using the book value. Riya, you are asking in preference share cash flow beginning 110 minus 2%, right? So initially you are spending 107.8 and then you are getting in return is 5 dividend and 100 redemption value at the end. Riya, is that okay? $110. Let me show you. So they're talking about a preference share of 110 market price. So this is 110 and they've given us a 2% flotation cost. The discounting factor, present value of annuity. Annuity means series of payments, guys. Please listen to me. Let me explain this once again because I think a couple of students are asking this question to me. If we are talking about series of payments here, let's say for 5 years, this is annuity. So that means we have to add these factors. This is annuity. But if I'm looking at only at something here, this is present value of single amount. Like in our case, we had a preference share or a debenture redemption value. We are only using this amount. So that's the difference between an annuity factor and a present value of a single amount factor. Okay, Riya, thanks for confirming. Vrinda, any specific doubt you had, or is it clear to you as well? I think you were asking something. Now, those of you have got it clear, can you also quickly calculate the cost of capital, weighted average cost of capital using market value as weights? So who is going to give me the market value, guys? What is the market value for debt, debentures? What is the market value of the debentures? Let's quickly calculate the market value weights. Yeah, Pooja, the table is generally given. So debentures market value is, how many debentures we have? 5,000. 5,000 multiplied by 105. 525. What is the market value of the preference shares? Again 5,000, I guess. 5,000 into 110. So preference shares is 550. What about equity? What about equity? Equity, you have 1 lakh shares to 24. So 24 lakhs. So that means my total capitalization base is 34,75,000 here. 3475. And hence, when we are applying these weights, 5.25 upon 34.75, 5.5 upon 34.75, and 24, we get a 8.57. 8.57, guys. Many questions in your historical papers have been actually requiring you calculate weighted average cost of capital using market value, book value, both. The idea is that you need to be very careful, because in this particular question we had to calculate the individual component as well. So we first calculate the individual components and then calculate the WACC. Great, good job, guys. So that was a good teamwork here. I think everyone did a good job. Everyone participated as always. And I'm pretty sure that today, whatever we did on Tuesday is now making more sense to you all, because you are now considering that, okay, this is my capital structure, this is how I plan to build up my business, this is my cost of capital, because the capital may be coming from different sources. Now, one small concept which is very important is marginal cost of capital. Now, the very important statement, the first one, the marginal cost of capital is cost of raising an additional rupee of capital. The word is marginal here. So we're looking at a cost of raising an additional rupee of capital, friends. So don't you relate this to, if I want to expand, Pooja had a question. Pooja, we allocated the weights, na? 3475 was the total. That total was individually 525, 550 and 24. In the same ratio, you use that weight to multiply with the individual cost of capital components, because our question was to calculate WACC. Pooja, we use that here to multiply these 6.9, 4.09. So we had that weight was used to calculate the WACC. Okay, coming back. So guys, when I'm looking at a marginal cost, imagine that if I want to expand, I have two choices. Either I can use my retained earnings, generally I do that, or I might have to raise additional capital. And if I'm doing that, because my cost of equity, new equity I should say, goes up because of flotation cost, that is why my WACC will go up little bit, slightly. This is the marginal cost of capital, guys. Marginal cost. Let's understand this. How do we calculate what is my marginal cost? First, we need to understand what is my proportion. How do I plan to finance my expansion plans? Because what happens is, when an organization intends to keep a specific ratio, like we had some ratio, this much debt, this much preference share, this much retained earning or whatever. So that is a proportionate manner which management decides. So when firm raises the funds in proportional manner and the components cost remains unchanged, that will be unchanged, there will be no difference between average cost of capital and the marginal cost of capital. But the problem is, this is only happening when you have enough retained earnings. Let's say I decide that I will keep on having a ratio of 1:1:2. Let's say 1 is my debenture, 1 is preference share, 2 is my equity. And I'm just giving an example, guys. I'm just giving an example here. Let's say I need a expansion plan of 1 lakh rupees. I'm using 1:1:2, where 2 is my equity. So equity component needs 50,000. And let's say there is a retained earnings already there, let's say, which is 65. So you know that probably you could take 50,000 from retained earnings. You don't need additional cost here. Additional equity. Fresh equity is not required. Probably you might want more debenture or preference shares, but you may not want to issue a expanding in a pre-decided proportionate manner, and the individual cost components remain same. So that means my KP, KD and KE are all same. Then there is no marginal cost of capital. That means average cost of capital is nothing but a WACC itself. There is nothing additional. So there is no difference between average cost of capital and marginal cost of capital. There is no marginal cost. However, let us assume that in this case, instead of 65,000, my retained earnings were only, let's say, 30,000. In the same example, that means balance 20,000 had to be with the new equity. Balance 20,000 will be coming from the new equity. I have to raise fresh equity share capital. So this is what we are talking about here. The component costs remain up to a certain level, and then they will start increasing with the amount of funds raised. Whatever the funds I have to raise from the market, additional capital, that will definitely raise my cost of capital, guys, here. Guys, I hope marginal cost of capital is sinking in a little bit. If I may ask that, is this concept clear 60-70% as of now? Because I will be discussing a question here where it will be 100% clear. I hope whatever I have explained till now it's making sense to all of you. Can you just confirm, please? Okay, so let's try to, like, some of you Some of you might have been understanding, some of you might be having some doubts. What exactly we'll do, how exactly we'll do. Let us try to understand this also with the help of a question here. Just give me a second, guys. Okay. So I'm just sharing a comprehensive question to you. Let me know once you can see it. Okay. So let's try to go through this question together. So Dhamaka Limited has the following capital structure. Examine which is considered to be optimum as on 31st March 2019. Okay. So company has a market price of 23.60. Next year dividend is 50%. So let's do one thing. Just give me a second. So let's also try to mark some of the important information given to us in this case. Yeah. So in this case, what's happening is they're given to us a capital structure, which is, we know that's okay, 30, 10,000, 160. So total is a 2 lakhs. Company has a share market price of 23.6. Next year dividend per share is 50% of 2019 EPS. Okay. Following is trend of EPS for the preceding 10 years, which is expected to continue in future. Guys, does this trend tell you something? Does this trend tell you something? Does this trend make sense to everyone? And any particular observation? I can see my EPS increasing over the number of years, but any specific trend? Any specific trend? Let's see what are the response about growth. Saurabh, excellent. Saurabh says that there is a trend in the growth every year. Can I see the EPS is kind of increasing almost by 10%, guys? Can I say that growth is 10%? Company issued new debentures carrying 16% of interest. And the current market price of debenture is 96. Okay, great. Preference share 9.2 with an annual dividend of 1.1 per share. Company is in 50% tax bracket. So what we are asking from ourselves is calculate after tax cost of new debt, cost of new preference shares, new equity share, assuming new equity from retained earnings. Calculate the marginal cost of capital when no shares are issued. Guys, what did I tell you? Marginal cost of capital when no new shares are issued is nothing but average, weighted average cost of capital. There is no difference then. When there is no new shares issued, there is no difference. It's same as WACC. So we'll calculate that. Determine the amount. Okay, let's focus on question number A and B first. Can you guys give me a cost after tax cost of debt, KD? Let's target to calculate the cost of debt first. what is cost of debt? So we're looking at a KD. Interest. So cost of new debt, and we are given 16% interest rate and the market price of 96, and there is a 50% tax bracket. That means 16 into 1 minus 0.5 upon 96. Which seems 8.33%. Is everyone with me on this? Jay, I received your answer, 8.33%. So we're getting 8.33%, guys. I hope this makes sense to everyone. Now let's quickly move on to KP, cost of preference shares. New preference shares. I think that is pretty simple. Preference share rupees 9.2 with an annual dividend of 1.1 were also issued. What do we do then for preference shares? There is no tax shield, right? There is no tax shield. So for the cost of preference, we're talking about a 1.1 upon 9.2. What's that? So it's like 11.96% or probably 12%, we can say, whatever. Cost of preference shares. And then we are talking about cost of equity as well. Charu says, why 96? It is new issue, not existing. So that's what we are doing now. Okay, good question. So what should be taken, Charu? We are talking about current market price, but the new issue would be at the current market price itself. In this case, the current market price and net proceeds would be same. Do you agree? They haven't given you any other flotation costs and all. Charu, we are using the same because that has to be net proceeds. But that was a good question, by the way. That was a good observation. I hope it is clear. Okay, some of you have already given me answer of KE. Some of you have already given me the answer of KE though. So for the KE, we have a market price of 23.6 and next year dividend per share is 50% of 2019. So what will be my next year dividend? 2.36 into 50%, that's 1.18. So KE is equal to D1 upon P0 plus G. So what is D1, guys? D1 is 2.36 into 50%. That's 1.18 upon 23.6 plus growth rate is 10%. Five plus 10, 15%, guys. I think some of you said cost of equity. Jay, can you double check your cost of equity should be 15, not 10? Okay, so we solved question number A. Question number B says calculate marginal cost of capital when no new shares are issued. So no new shares are issued, guys. So what will be my WACC here? Can anyone calculate quickly WACC? No new shares are issued. I guess they have already given us the weights here. See the capital 5. Everyone with me on this 13.85. Let's see, you want to give the answer. Okay, I received answer from Pooja. What about others? I hope everyone has calculated this. Guys, so question number A and B are done. Now in question number C, they are saying determine the amount that can be spent for capital investment before new ordinary shares must be sold. And I look at this assumption. Assuming that retained earnings for the next year's investment are 50% of 2019. 50% of 2019. So 2019, what are the retained earnings? Any thoughts? What are the retained earnings for in this case? So we are given 2.36 multiplied by how many number of shares do we have? 10,000 multiplied by 50%. So we have 11,800, I guess. So we're talking about 11,800. Great. I can see responses coming in from Rohan, Saurabh, Jay, Pooja. Everyone is absolutely rock solid form. So 11,800. And the call of the question is determine the amount that can be spent for capital investment before new ordinary shares must be sold. Now we have 11,800 as a retained earnings available, and we have a capital structure of 3:1:16. 16 is retained earnings. That means 11,800 is 80%. In that case, what will be the 100% amount? That is what my answer is. So 11,800 is 80%, guys. That means if we have to invest 14,750, so if we have to invest, we have to start a new project of 14,750. We are looking at our debentures, preference shares, equity. And in equity, we are using 11,800. The rest of that will be debentures and preference shares coming from their fresh issue. So that's okay. The call of the question was how much amount that can be spent for capital investment before new ordinary shares must be issued. So that means answer is 14,750, guys. So that means till 14,750 more, till additional 14,750, my WACC is nothing but my marginal cost. So there is no additional cost. WACC may there is no change. But beyond 14,750, my cost of equity will go up because of the flotation cost. Guys, am I making sense now? I hope marginal cost of capital concept now is clear. Pooja, 11,800 were my retained earnings available for investment. That is 80%. So 100% is 14,750. So that means till 14,750, there is no additional investment, or rather additional investment from new shares. Guys, let me know if there are any questions till question number C. Okay, so I just realized it's almost 7:20, past 7:20. Let's take a quick 10 minutes break here. Let's take a quick 10 minutes break here, and then we continue our discussion on the question number D here. And we will move on to some more practice questions after the break, guys. So please go freshen yourselves and let's catch up in 10 minutes from now. Okay, guys. So welcome back, everyone. I hope we had a good first half of today's session, rather 1 hour 20 minutes or so, and we're pretty energetic. And I'm sure we're in the middle of a very interesting question, which relates to your marginal cost of capital. Now, I can see a couple of questions while we were on the break, which is coming from one question is coming from Saurabh. Saurabh, you're absolutely right. We are talking about given the optimum level of capital structure. So rather, when you're talking about when you talk about the structure, you're talking about the proportion. So although my capital is given to us as 2 lakhs, but if I'm looking at additional 14,750, that also in the same proportion. So Saurabh, you're absolutely correct over there. Also, Sharon is asking me, how do you get 80%? Sharon, because I've been given that this 2 lakhs, the proportion of equity is 1,60,000. So the ratio was 3:1:16, or I could say like 80% of the capital structure is equity. Sharon, I hope that's your question taken care of. So guys, we had to. Charu said you did not get the C part. Charu, I explained that part before the break, but I can just do a quick recap. That so Charu, what we did was, in the question number C, they're saying determine the amount that can be spent for capital investment before new ordinary shares must be sold, assuming that retained earnings for the next year's investment are 50% of 2019. Now, in 2019, my earning per share is given to me at 2.36. Charu, 2.36 is the retained earnings given to me. That multiplied by 10,000. That means my total earnings, which is like from my earning per share, so my total profit, my total earnings is 23,600. And they're saying that 50% of the next year's investment will be again from a retained earnings. So that into 50% is giving me 11,800. So 11,800 is actually coming from retained earnings, which is basically 80% of my total capital, or rather 80% of my additional investment. So that means 100% will be 11,800 divided by 80%, which is 14,750. So that means I can spend 14,750 without raising the additional share capital. 11,800 comes from the retained earnings itself. So because retained earnings are part of equity share capital, right? I hope, Charu, that is clear now. Now, guys, let's move on to question number D then. Let's talk about question number D. So D says compute the marginal cost of capital when the funds exceed the amount calculated in C, assuming the new equity is issued at 20% or 20 per share. Didn't I tell you beyond a point in time? Beyond the point of time, let me just go back quickly to the presentation for a second. I want you guys to read this point. The component cost may remain, I'm talking about this one, guys, the last point. The component cost may remain constant up to certain level of funds raised and then start increasing with the amount of funds raised. So that means till 14,750, there was no WACC hike. My WCC was same. Beyond this, my WACC will increase because I will be raising fresh equity, guys. And that's what the question is. How much will be my WACC? How much will be my marginal cost of capital? So let's calculate that also. Now, if I have to raise fresh capital beyond that point, what I am doing here? I need to calculate new cost of equity, isn't it? I have to calculate the new cost of equity, guys. So let's do that. let's calculate the new cost of equity once I am deciding that, okay, I need to raise fresh capital. So for question number D, my new cost of equity, what will be that? New equity is issued at 20 per share, guys. 20 per share. So what will be the amount I should be using here? So that means I had a 1.18. I guess that was my D1. 1.18. My net proceeds are now less, plus a growth rate of 0.10. Can anyone tell me what is the new cost of equity here? Charu, yeah, absolutely. Thanks for confirming. I think you asked a question, but you got the answer yourself. Good. So new cost of capital in terms of this, someone said a 15.9% is what Pooja said. Guys, can you just double check? Is it 15.9? I think she's right. So it seems a 15.9%. Now look at my older cost of capital, cost of equity, by the way. My older cost of equity was 15%. Now it is 15.9. So that means without even calculating with a naked eye, I can say that new WACC will be definitely more. New WACC will be more than 13.85, guys. Anyone can tell that. New WACC will be more than 13.85 because I am raising new capital now. So let's do a quick mathematics here, and you guys need to tell me the answer. You guys have 30 seconds. So new WACC 3 by 20 into 8.33 plus 1 by 20 into 12 plus 16 by 20 into 15.9. You need to tell me. So what will be my new WACC? Brinda asked from where we have taken 10,000 shares. Brinda, 10,000 shares right here from the capital structure. Guys, very important to read the question information carefully. Does this make sense to everyone? Okay, so I got first answer coming from Saurabh. Saurabh says 14.56%. Saurabh, didn't I say that it will be more than 13.85? It had to be because my cost of equity was up, guys. Guys, now you understand the concept of marginal cost of capital. My WACC increased from 13.85 to 14.56 here. Slight calculation difference, Pooja, you can check it later on. I think 14.56, 14.57 looks to be a correct answer to me. Great, guys. So let's move to the presentation. I guess you guys all have a copy of it already, so you have the answers there. You guys can refer to these answers later on. I think the most important part of this question was the point number C here. That was the most important part. But I guess that was a good question, isn't it? That was a good question. You know, probably we are doing kind of two things, or rather hitting two targets with one sword here. Okay, great. So good job, guys. So a good round of applause to all of you from my side. So I think that was a good team effort. You guys were absolutely fantastic in terms of responses as always. Let's move on to another question quickly, guys. So we'll do a couple of more practice questions. I will absolutely give you one homework question as well. So now this one, a company wants to raise additional finance of 5 crore in the next year. The company expects to retain 1 crore earning next year. Okay. So that means further details are given. The amount will be raised by equity and debt in the ratio of 3:1. Amazing. The additional issue of equity shares will result in a price per share being fixed at 25. Debt capital raised by the term loan will be 10% for the first 75 lakhs and 12% for the next 50 lakhs. There's a very interesting point. For the debt capital, you have two cost of debts, 10% and 12%. But mind you, you also have to consider the tax rate, which is given later, 25%. So that's given to us also. Now, you are required to determine the amount of equity and debt for raising additional finance, post-tax average cost of debt, additional debt, cost of retained earnings and equity, and overall weighted average cost of additional finance after tax. So, interesting question. Probably, I would expect you guys to solve this simultaneously with me. You need to give me an answer for question number A. To determine the amount of equity and debt for raising additional finance. How do I calculate, or what amount of equity and debt I need, guys? Let's see who can answer this one. So for question number A, we are looking at an option of 5 crore additional finance, and they have given us 3:1. So guys, does that mean that equity is a 3.75 and debt is 1.25? Does that mean the same? Is everyone with me on this? However, they have given us, the question is calling for, the call of the question here is to determine the amount of equity and debt for raising additional finance. They have anyways told us there is 1 crore coming from retained earnings. So 1 is already there. That means you have to raise additional 2.75 of equity. In debt, you have further two parts, 75 lakh at 10% and remaining 50 lakhs, the remaining 50 lakh at the rate of 12%. So I hope this is clear to everyone. So 3.75 and 1.25 goes to equity and debt. Equity may they have given us that you are taking 1 crore from return earnings, so 2.75. Debt may there are two parts given to us of 75 lakhs and 50 lakhs from point number 3. I hope everyone with me on this side. Yeah, Charu, retention would be from the earnings itself, na? So why would you, if you are willing to retain 1, then probably you can use that 1. Charu, I hope that makes sense. Okay. What about question number B, guys? Question number B. To determine the post-tax average cost of additional debt. Now, please read the question carefully. Post-tax average cost. Why are we asking average here? Because we're talking about two types of debts, isn't it? Two types of debts. So let's do that. So what are the two types of debts here? Post-tax average cost is what we need to calculate. Who will give me the answer for this? So we're talking about two different ones, 10% and 12%. 25% is the tax rate, guys. So that means there are two cost of debts. One is 10 minus 1.10 minus 1.25, that is 7.5. And then there is a 12%, which is again net of tax, which is 9. So I'm getting a 7.5 and 9, which is after tax, but you have a 75 and 50. So which is like 3:2. This into 3/5, this into 2/5. So we're looking at a 4.5 here and a 3.6 here, net 8.1. $8.1. Saurabh, can you please check? See, there are two interest rates given to us, 10% and 12%. Tax rate is 25. So 10 into 75% is 7.5. 12% is 75% is 9%. So based on 7.5 and 9, I applied the weights 75 and 50, 3:2. So I seem to get a 8.1. Can you please double check, guys? I hope everyone with me on this. Pooja, basically what we're talking about in this case, that debt of total 1.245 crore is 75 lakhs coming from 10% and 12% coming from 50 lakhs. So 75 is to 50 is nothing but 3:2. Khushi, you have an interesting question. Khushi has a very interesting question. Khushi says, and I think probably some of you did that. 5 minus 1, 4 ko 3:1 you guys want to do. But Khushi, in that case, my question to you is, retained earning is part of equity, right? If you do that, the total equity will be 4 and debt will be 1. So your ratio changes then. You wanted 3:1, you end up having 4:1. Khushi, I hope that makes sense. We wanted to have a 3:1 and retained earnings are part of equity. Khushi, is it clear? Okay, so guys, I hope question number A and B are clear to everyone. Let's move to question number C then. Let's see what C has in store for us. Determine the cost of retained earnings and cost of equity. So in this case, I think there is only one. There are no separate two returns, or rather, we just calculate one cost of equity, and that should be it. The cost of retained earnings as well. So which model do we use, guys? I think the growth model. So we use the growth model for calculating the cost of retained earnings. Net expected dividend on equity share is 2 per share. So D1. So D1 will be 1.05. and this is 25 plus 0.05. How much we are getting, guys? What is cost of equity? Harsh, is it exact 13%? I think I am getting 13.4. Yeah, that's okay. That's okay. Harsh, that's absolutely fine. I just wanted to double check that it was not a typo from my side. Okay, guys, I hope everyone on the same page till question number C here. Rohan, because we are calculating D1. D1 is D0 multiplied by 1 plus G. Rohan, this is actually very important. In some of the questions, they give you a dividend after 1 year, but in this case, they have not mentioned dividend after 1 year. Sort of expected dividend, but not after 1 year. They have not told us after 1 year. The word after 1 year is not given to us. Expected dividend could be in near future also, but it is expected to grow at 5%. And also, it is always better that in these cases, in case of the language issue, in case you have anything to be concerned, even in the examination question, please mention your assumption, but assumption should be logical. You know, what are you considering? If you are considering is D, in any other question, if you are considering it as D1, mention why you are considering as D1. Okay, guys, let's come to question number D then. To compute the overall weighted average cost of additional finance after tax. Now, I think that is pretty simple, but let's jot down what do we have here. How many overall sources of capital do we have? Majorly two, but and when we anyways had a weighted average cost calculate for the debt, right? So the last one should not be a difficult one. So we originally thought for the WACC, I have a cost of debt of 8.1, which is into 1 by 4, and then 13.4, which is multiplied by 3 by 4. That should be my WACC, I guess. Straightforward. 3:1 was given to us, isn't it? 3:1 was given to us, guys. I hope this is making sense to everyone. So what's the answer here? Anyone who has calculated this already? Charu, so retained earnings is part of equity itself, na? 3:1. I think you asked the same question or someone else asked the same question. 3:1 includes the retained earnings. And cost of retained earnings is equal to cost of equity. If you want to split it up, you can, but you will get the same answer. Because you will split equity within the equity at the same rate. Had it been a new equity, let's say cost of equity was more than cost of retained earnings, then I am with you. Then you would have to calculate the WACC bifurcating the KR and KE. But I think you got a very, very valid point. You might have to be careful because in some questions, if there was a new equity, you will have to split it up into the retained earnings and equity. So your point is valid, because even if you would split in this case, you would get the same answer. So I think the answer I'm getting is 12.08 from majority of you. Good job, guys. That was amazing. I think, again, a pretty interesting question, but I'm sure you guys are getting a hang of WACC as a concept. Great. Good, guys. So later on, you can refer to the answers as well, although we solved it simultaneously, but that was good. Now let's move on. It's time for some brain teasers, guys. Let's see. Question number 1 for you, 30 seconds. Question number 1. Let's see who wants to answer first. So I've got many answers as C, but one answer as A also. Guys, I think this should have been easy one, isn't it? Which of the following cost of capital required to adjust tax? I guess we only have one source, that's your long-term debt. Equity shares, preference shares, dividends are not tax deductible. So is the case of cost of retained earnings. So answer is C, guys. Okay, what about question number 2? Question number 2. So who wants to attempt question number 2 quickly? You guys will have to answer this. Question number 2, guys. So in the question number 2, we have given a 12% KP is given to us. KE is also given to us. And I think KD is also given to us, but a little bit careful. For the KD, you need to do 1 minus tax. So you have to just apply weights. So that's 10.5. You have to just apply weights. So I think Rohan answered that question. He says 13.48%. So all of the rates are given. You have to just apply the weight here, guys. So that's absolutely correct, Rohan. So we have 16% given to us, 12% given to us, 10.5 we just calculated and we just applied the weights. That's it. 16, 12 and 10.5. That's the weights basically we are talking about in terms of 50, 15 and 35. So these are my weights. I hope WACC was a simple one. Let's look at more MCQs here. Yeah, Pooja, absolutely correct. Let's talk about question number 3 then. Now this could be an interesting question, so try it with being a little bit careful. Which of the following is an implicit cost of increasing proportion of debt of a company? Implicit cost. Implicit cost, I believe everyone understands, is implied. So what should be the answer for question number 3? Okay, so I think I'm getting mixed responses. I've got 3 different answers: A, B, and C. Khushi, Jyot, and Vrinda. A, B, and C. PE ratio of a company would increase. Yes, P is price earning ratio, right? Market price upon EPS. How would you conclude just by looking at increasing proportion of debt of a company, anything on the PE ratio? I don't think we have enough information for question number A, or rather answer option A. I don't think we have enough information to conclude that. Tax shield on the interest would be less. Why? Tax is same, right? Tax is as per the law. I am not sure of option number A. I am not sure of option number B. We are left with option number C and D. Look at option number D. Return on assets may decrease. Yes, again, the point is, if my proportion of debt is increased, why I am saying my return on assets may decrease? Probably because of the financial leverage. My overall return, my return might go up. It might go up also, because I am increasing the debt proportion. But the point also was implicit. Even if I say that, okay, I have a more interest cost, and you guys want to say that, sir, more interest is there, my net profit is going down. The word was implicit, implied cost. I'm not saying explicit cost. So even if it is less, even if the financial leverage impact is not yet shown, my interest is bringing the earnings less, D cannot be the answer. So that means we are left with C. See, because the point is, when you are increasing the proportion of debt of a company, what you are adding is to the capital structure, to the organization, is more risk. And definitely in that case, the expectations of the equity shareholders would be higher. So the answer is C, guys. That was a wonderful question, I guess. And I think probably some of you got it right. I'm actually impressed. Those of you got it right, you're absolutely champions. And everyone else, I'm pretty much sure that you got the point. This was an interesting question. Okay, guys, let's move on to question number 4 then. Question number 4. Yeah, Sushil, absolutely correct. Pooja, are you sure? Pooja has already given me answer for question number 4. No, who it is? Khushi. Khushi, are you sure of question number 4 answer? I think most of you are giving me option number B here. Preference dividend is 18, share currently is 122, and the flotation cost of 4. So how have you calculated? Should not have been a difficult one though. 18 upon 118. looks to be a 15.25%. So option number B, guys. I hope this is making sense to everyone. I guess one question was tricky. Everyone was pretty much comfortable on the other questions though. Great. Let's move on now, guys. Let's talk about another question, which talks about the weighted average cost of capital. Now, look at the requirement of the question here. The requirement is weighted average cost of capital using market value weights. So, market value weights we have to use, and we have given as a book value capital structure. Equity shares, reserves and surplus, preference shares, 8% debentures. Look at that, guys. We have two long-term debts here, 8.5% debentures and 12% term loans. They're given the debentures are redeemable at par after 5 years, quoted at 985. Current market price per equity is 60. They have given us a risk-free rate also. So we are talking about a CAPM model. And then preference share is also given to us. So let's jump in on this one pretty quickly, guys. I'm pretty excited. I guess you guys are also very excited. So let's do a quick calculation. Who is going to give me a answer for cost of equity first using CAPM model, guys? So cost of equity, CAPM model. Let's see who wants to give me an answer here. So we are having a 5.5. This market, so should we do 7 minus? Should I? This is also premium, guys. So that means we don't do multiplied by your beta, which is 1.85. They've already given us market risk premium, not the market rate. It's not RM, guys. It's RM minus RF. So RM minus RF is already given. Of course, that means my RM would have been a 12.5%. We don't need that. Though I'm just telling you. Yeah, Charu, absolutely. Rohan, I think you need to just double check. I think you did that. Rohan, are you clear now? I'm taking up this question intentionally so that you guys are careful. RA minus RF is already given. Okay, I will. Brinda, I will write a little bit on the down. Thanks, Brinda. Okay, so cost of equity is 5.5 plus 1.85 into 7. That's 18.45%. Now, what about the cost of preference shares? Redeemable preference shares, guys. So, a preference shares, we're talking about a 9 here. And then preference shares are redeemable. They're currently selling at 102. And they're redeemable at 10% premium. So we're talking about a 110 minus 102 upon 5. And then 110 plus 102 upon 2. 10.6 upon 106. So we are looking at a 10% here. Cost of preference is 10 point, so it coming out 10% exact. Saurabh, can you double check? I think you took 9% directly, but it was a redeemable one. Is everyone with me till now? So that is your cost of preference shares. That's 10%, guys. Then we are looking at two types of cost of debts here. So 35% is my benefit, right? So debentures are redeemable. So let's say cost of debentures. Again, a redeemable debentures, isn't it? So we're looking at a 8.5 into 1 minus 0.35. And then my debentures are quoting at 985 here after 5 years. So redemption value will be 1000 minus 985 upon 5. 1000 plus 985 upon 2. Who is going to tell me the answer for this? I think we are getting a 5.87%. Guys, if you are not able to see any part of the screen, don't worry. We have the answers coming on the next slide anyways. Then the KP is 10%. So my cost of debt is coming to be a 5.87. Yeah, it is 85, not 8.5. Thanks. 85. That's okay. 85. I think I took at 85, but I just mentioned that 8.5. But there is one more debt in this case, guys. There is one more debt, which is a long-term loan. So let's talk about the cost of long-term debt, which is 12% multiplied by 1 minus 0.35, which is a 7.8%. Is everyone okay here? I hope individual components cost is okay to everyone. And once you have calculated the individual components, we can easily do a market valuation and use that weights to apply a WACC here. Guys, cost of the long-term loan, 7.8% is clear to everyone. 12 into 1 minus 0.35. 12% is given to us here. So that's 7.8. So guys, once you have these with you, 5.87, 7.8, 10 and 18.5, we have to just calculate the market value which is given to us in the question. So we're talking about a market value. So equity, we had a market value of 60. So equity had a market value of a 60, then 102, and then debentures of a 985. Now these market values are given in lakhs here, so don't get confused in terms of the zeros. So we have calculated the weightage and applied the same to calculate a WACC here. So I hope everyone is okay till now. You guys can cross verify your WACC calculations later, guys. Any doubts, let me know. Vrinda, I hope now you can see the cost of preferential as well. Okay, great. So guys, you can please check your calculation for WACC later. I would want to cover one more question in the class, and then probably we'll give you one question as a homework. Okay. Okay. Someone said from where we get rupees 85 for debentures. 8.5% debenture into 1,000 each. So 1,000 into 8.5% is 85. Prema, I hope that is clear. Market value, Charu, market values are given na. Debentures ke liye you have 985. Equity shares ke liye you have 60. Preference share ke liye you have 102. It is given to us. Vrinda, I used 5.5 and 7 only because they have already given us risk premium. What 12.5, I was just explaining you guys that what should have been the RM. If RM is 12.5, RF is 5.5 is equal to 7. That's already given to us in the question. Don't get confused. The 7% is already given to us. What 12.5% I mentioned just to explain you guys. Okay, guys, let's move on to the last question of the evening, and then I will also give you one question for the homework. Mogambo Limited, as they always say, right? Probably after the last or rather end of all the questions or all the sessions, we generally say that Mogambo Khush hua, right? So let's try a question of Mogambo Limited. So Mogambo Limited wishes to raise additional finance of 10 lakhs for meeting its investment plans. It has rupees 2,10,000 in the form of retained earnings available. So you have 2,10,000 available in the form of retained earnings, and you have a debt equity mix of 30-70. Cost of debt 1,80,000 till 1,80,000 it is 10%. After that is 16%. They have given us EPS, they have given us dividend payout, expected growth in dividend, and current market price. So the question is, first question is, determine the pattern for raising additional finance. Who will tell me the additional finance pattern? We have already tried couple of questions on this. We already tried couple of questions on this, isn't it? So 10 lakhs, we are looking at 3 lakhs debt, 7 lakh equity. In equity, you have a 2.1 lakhs as retained earning. That means fresh capital of 4.90. New equity 4.90. In the 3 lakhs debt, you have a 1.8 lakh of 10% and 1.2 lakhs of 16%. Does that answer question number A, guys? The pattern of raising the finance? That is question number A for us. Saurabh, absolutely perfect. But Saurabh, just remember that in the debt you have two different types of interest. Now, then they're saying to determine the post-tax average cost of additional debt, cost of equity, and retained earnings. That's okay. So we need to calculate the individual cost of capital. We have done that many a times. So our tax rate is 50%. So for debt, we have so let's do one thing. So we have 5% for this, and we have 8% for this, because my interest is, or rather tax is 50%. So we have two different types of debt here, 5% and 8%. So we could do an average cost also. So average cost would be 60% into 5 and 40% into 8. It seems to be 6.2% is my cost of additional debt. 6.2%. J, absolutely superb. 6.2%. So debt is done. Cost of equity, guys. So cost of equity, we are talking about a 4.9 lakhs new one. Okay, a dividend payout. So current market price is 44, EPS is 4. So my EPS is 4, dividend payout is 50%. So my D0 can be taken as 2 here. My D0 is 2. Hence D1 is 2.2, guys. So cost of equity is 2.2 upon 44 plus 10%. Seems to be a cost of equity of 15% here. I hope everyone on the same page. Okay, 6.2 is cost of debt, and a 15% is cost of equity. Is everyone with me on the cost of equity? Yes or no? Can you please confirm, guys? Pooja already replied. Anyone else? Great. So I think everyone is with me. So now the last step is to compute the overall weighted average after tax cost of additional finance. So that's okay. So we have calculated our pattern here. That was done. Average cost, you all told me 6.2%. The only thing we were left to quickly solve was my weighted average cost. So that was anyways known to us, 70s to 30, guys. So 15 into 70% plus 6.2 into 30%. So we're getting a 12.36 here. 12.36. I will give you all 30 seconds to have a quick look and let me know if in case you wanted to ask something. In case you have any question, let me know. Let me know, guys. Any question, please let me know. Okay, so 12.36 is what everyone got it, I guess. Okay. Great. So Khushi had a question here, part B once again. Khushi had a question, part B once again. Uh, in part of in part B, they were asking us post-tax average cost of additional debt, Khushi, and there were two types of debt. One at 10% and one at 16%. Since my tax rate is 50%, what I've done is 10% into 1 minus 5 is 5, and 16% is 16 into 1 minus 0.5 is 8%. Now, since you're talking about 1.8 and 1.2, that means 3:2 ratio. So that is what we have applied to the weightage of debt, and we are getting 16.2 here. Sorry, 6.2. So applying that weight, we got 6.2. That's question number B. Great, guys. I hope that solves all your doubts on this one, though. So that was amazing, guys. I think amazing. Thanks, all of you. I think that kind of ends up our session. One more question in my, this particular file, which I have already shared with you guys, I had already uploaded. The last question I'm giving you guys as a homework that relates to the Navya Limited or Navya Corporation. You guys are supposed to attempt this question yourself, and you also have answer for your reference. So do that as a homework, guys. Compare your answer. Otherwise, I think it was fun for both the sessions of cost of capital. I think it was worth it, right? So we talk about cost of capital, but I guess in terms of cost of your time, you guys were awesome students, absolutely participative. I think both the sessions you were giving me responses on each and every question. You were with me. And as I always say that, it's hard work, discipline, and dedication. These are the three things which will always take you to different heights, guys. So thank you all for joining in today evening. And it was amazing. And I'm looking forward to more sessions. Probably after a couple of weeks, we'll have some discussions on investment decisions. And you will all also be in touch with me almost on the entire section of the working capital management as well. So continue your hard work, guys. Continue some practice. Try some questions. Try previous year exam questions as well on cost of capital and other chapters which have already been done. So continue with your momentum. Stay healthy. Stay safe with your families and do make the best use of this time. And I wish you all best of luck and a very good night. Thank you all for joining in. It was my pleasure, and it will be my pleasure with all of you students, wonderful students. Take care, guys. Cheers. Session over.